The thing about predicting something that's really never happened in everybody's lifetimes is you have to take that risk of going through these little nuances. And I think we're in that. And I'm willing to take that risk that, yes, this is a very unusual thing for someone like me in my position to point out, but I see it every day. I see all these indications. I mean, then we have to ask yourself, why did the smartest people in Wall Street completely miss the collapse?
Today, we have Bloomberg's senior macro strategist Mike McGlone discussing the current economic landscape and his prediction for the next few months. McGlone says that while the Bitcoin ETF is awaiting approval, there are classic indicators of contracting economic cycles happening right now. And given the rapid pace of interest rate hikes, this could accelerate inflation, and a recession may arrive sooner than later. McGlone acknowledges the Federal Reserve's tightening measures, as well as the lagging indicators used to assess inflation, which he says is a big mistake. He draws parallels with the current market and that of the 1930s, which McGlone believes we're headed straight for a bull trap. Let's listen to the latest interview with Mike McGlone as he gives his market prediction for the second quarter of 2023 and how the Fed's next move will impact crypto and the stock market in the coming months. If you enjoy the content we do here on this channel, don't forget to hit the like button and subscribe.
Unemployment's going to be inching higher at 4.3%. Look at that body in motion. It hasn't even changed yet. And expect a mild recession. I still love that mild recession. Now, obviously, those of us who've been expecting recessions have been wrong completely, but I fully expect just a normal historical recession, reciprocal to the amount of liquidity we pumped and dumped from the system. And also a key thing that's really changing is there's been a lot of extra liquidity from people not having to make their student loan payments. That's off. We've had some major government programs. Those are going to be not ending, but curtailed soon as we get to election season. But for me, the bottom line is, yes, maybe we'll get lucky and get that announcement that BlackRock will get that crypto, that Bitcoin ETF, and then of course all the other people like the Winklevoss twins and everybody's been complaining for 10 years will get kind of upset, but we'll go back there. But that's the key thing. That's an if statement. The market went up. Did it go up? Or you expect it to go up because it went up? That's what I love. My favorite technical analysis. I remember dealing that with customers a lot. So it broke through resistance. It's going to go higher. The key reason I think it might have gone up, most markets went up, is because it went down. That is the main reason the crude oil market went down. And that's the main reason I think it's going to keep going down. But here's the issue is we are trying to predict, with most of us maybe have in front of me the terminal, I have minimum standard 50 years of data, trying to predict the aftermath of 100 years events with 50 years data. So last few weekends I went back to analyze most of the crises over history. Main ones in this country is the panic of 1907 and then 1930. I didn't say 29, I said 1930, because I compare this year to 1930. Stock market went up 50% from the bottom, and the rest is history. So for me, the bottom line is we are still in the midst of the Fed tightening. So if you look at Fed rate hike expectations, they're still probably not going to peak until let me just pull that up, until 5.4% in November. And right now they're 5.08, the effective rate. So there's still a lot more hikes in the system. And the key thing that I like to ask is, we have such a the Fed watches such lagging measures of inflation, personal consumption, expenditures, employment cost indexes. They've been stuck at 4 to 5% ever. But you look at the trajectory, they're starting to head lower. Fed funds still heading higher. So you have to expect all the lessons of liquidity not to matter for us not to have a recession and for us not to have a decent correction in the stock market. So now let's tilt that over to cryptos. I like to point out the fastest horse in the race, cryptos, have had an okay quarter. They went up about the same. The Bloomberg Galaxy Crypto Index went up more than the NASDAQ. It should, because it trades at basically a much higher volatility, but it's showing divergent weakness. Now, we're all getting bullish Bitcoin because we're supposed to get that ETF in the US. That's still an if statement. So I look at it going towards, let's say, by the next 6 months. First, so I hope you're right. I firmly hope you're right that we're going to get this continued. No, we're not going to have a recession. Everything's fine. The Fed can keep tightening. And the biggest pump in liquidity that's dumping is not going to matter. To me, it's the delayed reaction. Then the numbers I'm seeing are specific. And this is one thing I did expect, is the market to get all excited because inflation's dropping rapidly. But that's what happens in depressions and recessions. So right now, the producer price index is negative. The finished goods index, it's a year-over-year index. It's dropping at the fastest pace in history. Yes, my data only goes back to 1948. It was really hard for me to compare how fast that dropped in 1930. But to me, that's the macro I'm pointing out, and I'm really happy to be considered wrong by the end of this year for being McGlone by pointing out these facts. And then we have to be, I'll end with this, we have to be very careful pointing out that market's going to go up because it went up. Now we're at the stage it might go down because it went up. Now I get AI. I mean, remember, I was trading when we had the internet bubble. I was trading when we had all those fuel cell stocks. I remember they're great. But the key thing for the second half of this year is the way I look at cryptos, narrow down those cryptos. If we don't get a higher plateau from the stock market, that to me is the domino factor that's extremely negative for everything. Meaning the Fed will have tightened, those tightenings that have kicked in are still priced in and will be in for a while. They're not going to be easing like they have in the past. It'll start tilting lower and then there'll be nothing to save us. Like you've probably been trading for 20 years or so, I'm guessing, and single time the market went down, the Fed saved you. That's changed. So I'll pass it back to you. And again, I do hope, I hope you win this debate today. To me, it's really what happens to markets by the end of this year. And this is the most concerned I've ever been in my 35 years of being in the business about what can happen. And I compare it to 1930.
So massive bull trap, basically.
I think so. Yep. And bottom line is don't fight the Fed. The Fed's still tightening. Got another 30 basis points still priced in the market, and they're going to keep doing it. I think they're at the mode now. They're going to keep tightening until the market tells them not to, the stock market. We're at a stage now that's something that's really never happened in modern history, normal history. Is I look at it, you're sitting at the Fed and you read all their statements and read what they say is they're worried about core PC, personal consumption expenditure, which is 4.62%. Their target's 2%. And for me, I look at it as there is absolutely no incentive for them until something breaks, and obviously nothing's really significant broke, the number one thing to break, to make them stop tightening. I didn't say ease yet. There's no reason for them to ease. Everything's perfect. Inflation's going down for them. Economy's fully employed. Why take the risk of tilting, of what I think they're going to go back in history of being what Irving Fisher said. Irving Fisher, the famous economist, said we've reached a new higher plateau in 1929. That's going to think what's happening. So this is how historic it is. But the key thing I want to point out is, what did you fully expect? Some of us fully expect in this environment is people to say, oh, inflation is going down, it's great. It's not just going down. The producer PPI core at minus 0.9, next month is going to be much lower, is dropping its fastest pace ever in history since 1948. So why is that? Why did it go up? And that's the key thing I look at. I have a chart in front of me. I'm just looking at personal consumption expenditures. It went up for one reason, because we pumped the most liquidity in the system ever. And now we're taking it away. Just look at money supply. Money supply didn't matter. I remember trading in the pits in the 80s and we stopped looking at money supply because it didn't matter. But when it goes up the most and it goes down the most, that's what matters. And I just read this book recently. I knew it was facts, but called Booms and Busts. And all the biggest booms and busts in history have come back on the back of liquidity goes away. That's what this is. We're still in the liquidity going away, yet the market doesn't believe it. The stock market does. Now, the bond market does, the yield curve does, the commodity market doesn't believe it, does believe it, cryptos believe it. And I look at the opportunity here is, for next half, is that the big money is going to be made, not in leveraged long, because we already made tons of money.
McGlone currently forecasts a phase of deflation across various asset classes, with the exception of Bitcoin. He says this pattern will persist until there is a substantial lag from the Federal Reserve's implementation of monetary easing. He also highlights that central banks globally are still raising interest rates despite the world economy heading towards a recession, as evidenced by recent downgrades by the World Bank. McGlone does anticipate a future purification of the stock market, aimed at eliminating dishonest participants, similar to the cleansing process observed last year in the crypto market. Because of this, he highlights the high valuation of equities compared to GDP and expresses that the crypto market currently lacks a clear leader. What do you think about Mike McGlone's recent interview and prediction for the crypto and stock market in the second quarter of 2023, and how the Fed will play a role in the next few months? Comment down below. Thanks so much for watching. Don't forget to like and subscribe. We'll see you in the next video.